Okay, we are back. I'm very happy to have on the Goldstein on Gelt show David S. Rose. He's a serial entrepreneur who crossed the aisle to become one of the country's leading angel investors and then actually came back to the side of being an entrepreneur to found a company called Gust. David, you're an expert in angel investing. In fact, you really wrote the book. Tell us, what is angel investing all about?
Angel investing is where individual people, like you and me, take their own cash and use it to invest in the earliest stages of exciting startup companies that might be the next big Apples or Googles or Facebooks.
So what's the difference between that and venture capitalists?
That's a very good question. Many people, particularly entrepreneurs, often refer to angels and VCs or VCs and angels as if there were no spaces between them and they were the same thing. But they're really quite different. A VC or venture capitalist is a professional money manager who goes out and raises a big pot of money in the hundreds of millions or more from institutions that have a lot of money, things like pension funds or insurance companies or university endowments, as well as from super rich people who have billions of dollars. And so the VCs take that big pot of money and they go and invest it in companies that they think will have a high return. However, angels are individual people like us, although you have to be an accredited investor in the U.S., which means there are certain income requirements or asset requirements. And so we invest our own personal money out of our own personal pockets into companies that we think are high growth. The difference is that since we're typically investing a lot less money than big venture capital funds, we're investing in smaller companies at an earlier stage. So in the United States, angel investors invest more money than all VCs put together, something like $25 billion annually into something like 70,000 companies.
Is that through official angel investing channels, or would you, for example, call the parents of the inventor who give him $25,000 an angel investor also?
No, that comes under the heading of friends and family. And that's not when I'm talking about angel investors, I'm talking about real arm's length angels. But the interesting thing is the parents and the friends and family, they account for an enormous amount more, something like $60 billion annually in the U.S. But angel investors, those who do the 25 billion, these are arm's length investments by people who don't know you, and they're investing for economic reasons in this high growth company.
So let's just go through the stages. The first stage of getting money is having no money and working out of your garage. The next stage is friends and family.
Well, nope. The next stage is your own cash, because if you don't put your own cash, real hard cash, into your company, nobody else will. And that means so you got to have some cash. It's not a lot, but you have to show that it's means something to you, right? So your savings, your credit cards, whatever, you got to put your cash in first. Then comes friends and family, because they're investing not in the company. They're not company experts or business or angel experts. They're investing in you. They're backing you because they love you or they have faith in you, whatever. And only typically after you get to that stage are you then ready for angel financing.
Okay, so a lot of the things that people say kind of, on the street in the entrepreneurial world is that once you start bringing on the angels, they're going to demand a huge percentage of the company because they're putting up huge amounts of risk capital. Is that true?
Well, the question is how you define huge and what the alternative is, right? If your business needs capital to do whatever, to build the product or buy stuff, and you can't get it in any other way, and you have no business without the investment, then it's a good deal. In reality, angel investors and VCs typically do not want to take control of the company. They don't want a majority because it's very important to them that you, the entrepreneur, are incentivized, right? Because otherwise they'd have nothing worth anything. So typically, an entrepreneur should be prepared to give up roughly, between 20 and 30% of the equity in the company at any given round. Which should raise enough money to take them to the next level. So typically, in an angel round, you might be selling 20 or 30% of your company in exchange for the cash necessary to get off the ground and get going.
Do you think that a lot of times entrepreneurs believe they need money before they actually do?
Without question. That's actually a very astute comment, Doug, because in the real world, you say, how does this whole thing work? Well, a company, you have an idea. You're an entrepreneur. You have an idea for a company. What should you do? Well, the first thing you should do is have a business plan, check out the market, figure out how you get to your minimum viable product, But in reality, what happens is somebody has an idea and they say, okay, I need venture capital, right? Or I need an angel investor.
Money, right?
Right. And so that's not the way it works. These days, it is so inexpensive, particularly for IT-based companies, internet-based things, to go out and get your minimum viable product started. That in many cases you really don't need capital, and taking investment capital at an early stage is more of an intrusion and a distraction than anything else. So to the extent that a company can get started on its own by bootstrapping, I'm telling you as an investor, do not raise investment capital.
We're talking with David S. Rose, who is an expert in angel investing. In fact, he wrote a book called Angel Investing. We've been talking so far about some of the details of a company who might want to raise some money in order to get to the next stage after the entrepreneurs put in their own money, after they take money from mom and dad, and now they're ready for angels. Let's look at it now from the side of the investor. A lot of the people who are listening to the Goldstein on Gelt show are always looking for new ideas for investment. Is angel investing a reasonable type of investment for regular mom and pop people putting aside money to save for the long term?
Well, it has become a viable investment alternative. Until probably 15 or 20 years ago, it was some arcane, bizarre backwater. I mean, even more unusual than investing in, frog's eggs or something or other. But now the technology pace of technological development has advanced so fast that the world is changing. It's taking less money to start. More companies are starting. They can grow faster, have a bigger impact. And so it turns out that the average return for a well-managed professional angel portfolio is 25% annually. You compare that to, 1% you might get in the bank, or maybe 5% in the stock market, or 10% for a hedge fund if you're lucky. Or
over
maybe
what
even
time period are we talking?
No, that's annually. I'm talking annually.
I mean, over the past 5 years, 10 years, 50 years?
No. When there have been several studies probably that have been done in the last 3 or 4 years based on portfolios over the last 10 years or so. So these are pretty standard numbers. However, the trick is it's very risky. This is not like investing in the stock market. If you put your money in the stock market, you expect every company to either go up or at least stay the same. But when you invest as an angel investor, half the companies in which you invest are going to go bankrupt. And so you have to have psychological ability to understand that's going to happen. On the other hand, if you invest in enough companies, and in the book I suggest at least 20 or 30 companies, then you begin to hit the odds where the odds say that one out of those 20 or 30 is going to return many, many times the investment. I mean, literally 20 or 30 times the investment. And that ends up making the whole thing worthwhile. So the average person who calls him or herself an, quote, angel investor, end quote, actually loses money because they do it lackadaisically or emotionally, or they only invest in one company. But if you do it with real discipline and you hold for the long term and you invest in a lot of companies, the odds are very much in your favor to actually make quite a decent return.
One of the catchphrases that people use today in portfolio design is they talk about including alternative investments. Sometimes they'll talk about hedge funds or certain types of real estate. Do you consider angel investing an alternative investment?
Yep, absolutely. Angel investment falls into that category. You basically have stocks and bonds and then everything else. And so alternative investments include everything from hedge funds to real estate to private equity to venture capital to angel investing, which is sort of at the far end of the risk reward spectrum. So, I mean, I've been investing in companies that have returned, 60 times the original investment. You will never see that in the stock market. And on the other hand, I have a whole lot of companies that were very promising, but now no longer exist. So
one of the characteristics that we look for in an alternative investment, my day job is I'm a financial advisor. I help people sort of develop their long-term financial plans. And we do talk about alternative investments, but we're looking for things that are not necessarily correlated with the standard stock and bond investment portfolios. Do alternative investments fit that category? Would you call them non-correlated?
Alternatives in general, as I said, is a very big category. Angel investments actually are not correlated because angel investments take so long to come to fruition. In the United States, the average hold for an angel investor is 9 years of being completely illiquid before you have an exit, because the company, in rare cases, goes public or more frequently is acquired by a larger company. But if you're holding for 9 years, you're really uncorrelated. It's illiquid over that period of time. The value doesn't go up or down. If anything, it follows a J curve, where after you put your money into a company, it immediately loses value as the company spends it on trying to get its product going, and then only after a while, after the company begins to make money, does the J curve tick up. So angel investments are typically uncorrelated.
Okay, so one of the things you mentioned before is that it's a good idea if you decide to be an angel investing to broadly diversify. You said 20, 25 different companies. For a regular person, that might be impossible. Is there a technology solution, and perhaps I even think you might have one, a platform that would help people to do this?
Well, there is indeed. There are several that are coming out. And obviously, you're mentioning Gust, G-U-S-T, which is a company that I founded. Gust is the global infrastructure platform for early stage investing. So basically, it's the internet tool and website that's used by virtually all of the angel investment groups in the world. Something probably like 70 or 80% of all the professional angel networks in the world, about 90% penetration in the United States. And angel investors use this to, collaborate with each other and manage their deal flow. So probably the best way to get started as an individual, first of all, is are you an accredited investor? In the United States, the regs are you have to have either $1 million in assets, not including your primary residence, or you have to have at least $200,000 in income, $300,000 if you file jointly with your spouse. But if you meet that qualification, then you're allowed to invest at will as an angel. And the best thing you can do to get started is to join a group of angel investors, because then you'll be able to get your feet wet, a little toe at a time. You'll have people who have been there before who can mentor you. You'll have ready-made deal flow to see deals that might be interesting. That's a great way to get started.
And I think the critical thing, David, that you're mentioning is that it's important to work within an established framework. If you are an accredited investor, make sure you speak to an advisor. Don't just speak to the salesman who's pitching a product or to your neighbor's kid who is the one who's asking you to put in the money. I think it's very important to do this as a professional would look into.
Absolutely. Professional. That's why I wrote the book. So the book that you referred to is called Angel Investing, The Gust Guide to Making Money and Having Fun Investing in Startups. And it's a great primer for anybody who's interested in this space. It's available, in ebook form and hardcover, and even audiobook, and it walks you through the entire process of finding deals, joining groups, analyzing, structuring them, and adding value to your portfolio.
It sounds like a very important book for everyone to read who wants to be involved in the field. David S. Rose, we are just about out of time, but in the last few seconds, just tell us, how can people follow your work?
Oh, you can follow me on Twitter and most social networks. My handle is at David S. Rose, no spaces, DavidSrose. If you happen to be on Quora, you can follow me on the website Quora.com, where I answer questions on the subject of angel investing in startups. And of course, if you're interested in looking at startups, come on to Gust.com, Gust.com, where you'll see literally hundreds of thousands of amazingly cool startup companies.
All right, and we will put links to all of that at the show notes of GoldsteinOnGelt.com. David, thanks so much for your time.
My pleasure.
You've been listening to the Goldstein on Gelt Show with money maven Doug Goldstein. Doug's weekly radio show is heard around the world, but if you miss it, you can download the podcast at www.goldsteinongelt.com. The Goldstein on Gelt Show gives you up-to-date financial ideas so you can get on the path to financial freedom. If you'd like your questions answered on the air or off, send Doug an email to doug@profile-financial.com. It's your money for your future, so join Doug every week to build your wealth on the Goldstein on Gelt Show.